This is the second of 3 lectures for Chapter 6, Individual Deductions. This video will cover the deductions from AGI. Just as a quick reminder, when it comes to deductions from AGI, the taxpayer is always going to take the greater of the itemized deductions or the standard deduction. Based on the last available data released by the U.S. government, only 17% of taxpayers take itemized deductions. As a taxpayer, you can spend your money on a wide variety of things, from clothing to houses to cars to entertainment. Unlike businesses that get to deduct all of the expenses that they incur, individual taxpayers are limited to a few expenses that are deductible as from AGI deductions. These would include medical expenses that are above 7.5% of the taxpayer's adjusted gross income. This also includes taxes that the taxpayer pays to other jurisdictions, such as taxes on real estate or state and local income tax. In some cases, the taxpayer may also be able to deduct taxes paid as sales tax on purchases made throughout the year. Individual taxpayers are also permitted a from AGI deduction for certain interests. This is limited to the interest incurred on a primary mortgage or investment interest only. Congress also permits itemized deductions for charitable contributions. These are limited to a maximum of 60%, 50%, 30%, or 20% of AGI, depending on the type of charitable contribution made and the organization to which the donation was made. Finally, Congress grants individual taxpayers the opportunity to deduct casualty and theft losses on personal use assets, as well as gambling losses. And in both cases, just like all the other itemized deductions, there are limits to the amount that can be deducted. Let's go through each of these in more detail. When it comes to medical expenses, the first thing that you have to think about is what expense did you incur that actually qualifies. Medical expenses include any money spent on prescription medication, insulin, medical aids, such as eyeglasses, contact lenses, and wheelchairs. It also includes payments made to medical care providers, such as doctors, dentists, and nurses, and facilities where you receive that medical care, such as hospitals or urgent care. Taxpayers may also deduct transportation that they incurred for medical purposes. If you're using your own personal vehicle, you would rate this at 18 cents per mile. Medical expenses also include money paid for long-term care and health insurance premiums. However, I include an asterisk here because most taxpayers are better off having their employer withhold their insurance premiums on a pre-tax basis. This would work effectively like a for AGI deduction. Let's look at an example to make sure we understand how this is going to work. Recall earlier, we looked at an example where Amani was considering contributing to a 401k through his employer. We learned in that example that the employer would reduce the Box 1 wages, tips, and other compensation by the 401k contribution. They would do the same thing if Amani elected to have his health insurance, dental insurance, and vision insurance premiums withheld from his check. The effect of this is that Amani would receive a 4 AGI deduction for the amounts contributed for his health, dental, and vision insurance, reducing his wages, tips, and other compensation to $42,150. Since this is the amount that he would report in Box 1A, his tax benefits for these payments are yielded through a 4 AGI deduction. So that we can make a full comparison, let's see what would happen if Amani did not elect to have his employer withhold these on a pre-tax basis. Here, I'm going to incorporate the other information that you received from the personal budget data analytics exercise, namely that he was spending $15 per month on medications, and that he also incurred expenses for eyeglasses, contact lenses, mental health care, and other visits to professionals. The sum of those is $1,110. We would add that amount to his health insurance premiums to find his total medical expense of $8,460. We would then reduce his allowable medical expenses by 7.5% of his AGI, $49,500. Yielding him with a deductible medical expense of $4,747.50. If this was his only itemized deduction, then he would still take the standard deduction, meaning that he would yield no tax benefit if he doesn't elect to have the health insurance premiums withheld from his check on a pre-tax basis. Now that we understand how to deal with medical expenses, let's take a look at the second category, taxes. Here, again, the first question that we need to answer is what qualifies? In this case, a taxpayer is allowed to deduct income taxes paid to states, localities, and foreign jurisdictions. Alternatively, if a taxpayer lives in a state that doesn't have income tax, then they could substitute the state and local sales tax paid for the income tax. Taxpayers may also deduct state and local real estate taxes paid on property held for personal or investment purposes. So this would be property taxes paid on a primary residence or a vacation home. Taxpayers could also deduct state and local personal property taxes that are assessed on the value of specific property. So, for example, in some states, when you register your car, your registration fee is based on the value of the car. We call this an ad valorem tax, and that would be deductible. Taxes are limited to $10,000 per tax return. Or if it's a married filing separate couple, then each one of the married filing separate spouses would be eligible for a $5,000 deduction. This actually results in a marriage tax penalty because if two taxpayers live in the same house and let's say they have a real estate property tax bill of $25,000, if they choose to cohabitate, each one could take $10,000 of tax per tax return. This yields them a $20,000 deduction on the $25,000 worth of taxes paid. However, if they chose to get married, then they're limited to $10,000, regardless of whether they filed jointly or married filing separately. So the cohabitating couple gets to take twice the taxes, even though both the married couple and the cohabitating couple pay $25,000 of property tax. All right, now that we understand the rules, let's look at an example related to Amani. In addition to Amani's deductible medical expenses, assume he purchases a home. He's going to pay $5,300 in mortgage interest in 2022. This is his primary residence, and the mortgage value is $150,000. And he also pays $3,600 in real estate taxes in 2022. He also pays $550 in ad valorem tax on his car in 2022. Let's calculate what Amani's itemized deduction would be with these items considered. Here, I pulled up Schedule A. That's where we report the itemized deductions for an individual taxpayer. Hopefully you recall that we had computed our allowable medical expense deduction using Amani's total medical expenses and reducing it by 7.5% of his adjusted gross income to arrive at the $4,747.50 of medical expense deductions. Then we would go ahead and remove his state and local real estate taxes of $3,600 and his property taxes of $550. In addition to the items associated with his home, let's assume that Amani pays $1,920 in state and local income tax. This gives him a total tax deduction of $6,070. Since this didn't exceed the $10,000, Amani is eligible to take all of that. Finally, as we'll discuss next, he's going to be allowed to take his home mortgage interest, which is $5,300. So we would go ahead and add up his allowable medical expenses, his taxes that he paid, and his interest that he paid for a total deduction of $16,117.50. Now that we've identified Amani's itemized deductions, we're going to ask the question, should Amani take the itemized deduction or the standard deduction of $12,950? Remember, you always want to take the greater of the two. However, we have one more choice when we're talking with Amani. Recall that he could have his insurance premiums withheld on a pre-tax basis. That means he gets a 4 AGI deduction for all of his insurance premiums. And if he chooses to do that, he would not have enough to take an itemized deduction, but he still does get his standard deduction of $12,950. And we can see that even under these circumstances, because of the limitation on the medical expense premiums, Amani would still want to have his insurance premiums withheld on a pre-tax basis and use the standard deduction because his taxable income would be lower than it would be if he used the insurance premiums as a from AGI deduction. Well, let's do one more example. Here, let's assume that instead he's going to pay $9,000 in mortgage interest and $4,600 in real estate taxes. He still will pay that $550 in ad valorem tax and the $1,920 in state and local tax. Now his itemized deductions have increased all the way to $20,817.50. But again, we might want to ask the question, should Amani take the itemized deduction or the standard deduction? And specifically, let's focus back on our medical and dental expenses. Even with these increased deductible expenses, we'd still want to encourage Amani to have his employer withhold his insurance premiums on a pre-tax basis. That's because he gets a 4 AGI deduction for the full value of insurance premiums paid. And then he can still claim itemized deductions for the property tax, the real estate tax, his state tax, and the mortgage interest paid. And if he does that under the last scenario, his taxable income will still be lower than it would be if he took his medical expenses as part of his itemized deductions. Now that we've seen these examples, let's just remind ourselves why it's usually better for a taxpayer to have their employer withhold their insurance premiums on a pre-tax basis. Effectively, what happens is the 4 AGI deduction will yield a greater tax savings because the from AGI deduction of those insurance premiums would be limited since you have to reduce them by 7.5% of AGI. Hopefully, these examples are helping you to see that there's a number of ways to talk to individual taxpayers about making tax-optimized decisions. Let's go through another popular category in the from AGI deductions, charitable contributions. Like all of the other from AGI deductions, let's start with what qualifies. You can contribute money, mileage and expenses incurred to volunteer, where the mileage is rated at 14 cents per mile, but you cannot deduct the cost of your time. So, for example, there's a very worthy organization known as the Volunteer Income Tax Assistance Program that is run in conjunction with the IRS. The closest location is either in Tupelo or Memphis. If I were to donate my time to the VITA program, I might be tempted to say, I'm going to rate the cost of my time based on what I would charge a paying customer for helping complete their tax returns. But you're not allowed to do that under the charitable contribution rules. Instead, I'd be limited to taking the deduction based on my mileage and any expenses that I incurred to volunteer. You could also donate property, and this would be either capital gain property or ordinary income property. Just like other from AGI deductions, your charitable contributions will be limited. In this case, the limits are based on whether you donate cash, capital gain, or ordinary income property, and what organization you donate to. To help understand this, I copied Exhibit 6-9 out of your textbook, and we're going to go through example 621. So let's talk first about the organization that you can donate to. Most people are familiar with donating to public charities. These would be charities that either say they're a 501c3 charity or you know them as a 501c3 charity. For the purpose of this class, I'm going to keep these charities to those big names that you'd readily recognize, such as the Red Cross or the American Diabetes Association or the American Heart Association or your university. On the other side, you could donate to private non-operating foundations. For the purpose of this class, you're really not going to see those, but the limits are there just in case you happen to have a personal situation where you have made a donation to these organizations. Now that we understand the type of organization, we can go through each of the limits. It's a little bit ironic that your book puts capital gain property ahead of ordinary income property, because when we go through the example, you'll see we apply the ordinary income property limits first before applying the capital gains property. It essentially goes in a waterfall where you apply the least restrictive and then navigate down to the most restrictive AGI limit. So with respect to cash, your value of the donation is based on how much cash you give. And then you're limited to taking a charitable contribution for your cash donations up to 60% of your adjusted gross income. When it comes to ordinary income property, which is the second most restrictive, here, this would be things like donating old clothes or furniture that you're not going to use anymore. In this case, you're limited on two fronts. First, the value of the property that you donate is limited to the lesser of your cost, the basis, or the fair market value at the time of the contribution. So when you think about going to Goodwill, you might have bought a dress for $500. But if the current fair market value of that dress is $20, then your donation is limited to the $20. And then you also still have an AGI limit. Here, it's 50% of your adjusted gross income for that year. Finally, if you made a donation of capital gain property, such as stocks or bonds, to a particular charitable organization, then your amount of charitable contribution is the fair market value at the date of the donation. But your adjusted gross income limit is the most restrictive at 30%. So that we can get a good sense of how all this works, let's go through example 621. Example 621 builds on examples 617 through 620, where we find Courtney, who has an AGI of $187,000, and we're told she makes $12,350 in contributions throughout the year. So that we know how we got there, let's go through each of her charitable contributions. She donated $1,700 in cash to the American Red Cross. Because individuals are not public charities, private operating charities, and private non-operating charities, she would not be able to deduct any of the $200 of cash that she provided to various homeless people that she met on the street. This same provision would apply, let's say that you're trying to help out a friend who had a really bad year, or you find a family at a particular restaurant that's asking for donations because their house burnt down or because one of their loved ones has a terrible illness. None of that cash will count because individuals do not count as any of the types of charities that we just identified. She also volunteered at Goodwill Industry, and we see that she drove a total of 500 miles during her volunteer work. That can count, but the estimate of her cost of time is not deductible. She donated 100 shares of stock to JBD Corporation, and this would be capital gain property. So she would be eligible to deduct the fair market value of the stock at the date of the donation. When it comes to her excess possessions, such as her furniture and clothing, here, that's ordinary income property, and we know that the charitable contribution is going to be limited to the lesser of the fair market value at the time of the donation or the amount she originally paid. In this case, the fair market value of $160 is well below the $900, so she'll get credit for that $160 donation. Let's cap out this example with our mileage, where we multiply the 500 miles driven by 14 cents per mile to find out that the value of that as a charitable contribution would be $70. So when we add up the $1,700 in cash, the $70 worth of mileage, the $10,600 stock donation, and the $160, we find that she made $12,350 worth of charitable contributions that can be deducted on her tax returns. Now let's see how the limits apply. She has $187,000 worth of adjusted gross income. We start by limiting her cash contributions. For the purpose of this limit, cash and mileage are treated the same. So we would add those two together, the $1,700 plus the $70 mileage allowance. And we would compare that to 60% of $187,000 or $112,200. We see that the value of her contributions is well below her 60% AGI limit, so she'll be allowed to take all of that. Next, we apply the 50% contribution. Remember, I said this is a waterfall, and we're going to go from least restrictive to most restrictive. Here, she made donations of excess possessions, which are ordinary income property, and the fair market value at the date of the donation was $160, which was well below her cost of $900. So we take the $160, and now we're going to compare it against her 50% AGI contribution limit. But we don't just take the 187 and multiply it by 50. We have to also reduce that 50% of AGI by the value of the cash contributions already recognized. So she would only be eligible to take up to $91,730 based on the 50% AGI contribution limit. Again, her actual contribution is well below this limit, so she'll take all 160 here. Finally, we're going to apply the most restrictive test. Here, we're going to compare the actual value of the contribution, which is $10,600, the fair market value of the stock on the date of the contribution, to both a 30% of AGI contribution limit and the remaining 50% of AGI contribution limit, which we calculate by taking $91,730 and subtracting out the deduction that was taken at the 50% level. When it comes to the 30% limitation, you're going to take the minimum of those three numbers. In this case, again, the fair market value of her contribution is well below the 30% contribution limit and the remaining 50% AGI contribution limit. So she'd take the full $10,600. And when we add those three properties together, the $1,770, the $160, and the $10,600, we can see that she's going to get to take the full $12,530 worth of charitable contributions. In this case, Courtney had a lot of AGIs, so she was eligible to take all of her charitable contributions. But just to make sure we understand how this works, let's go through an example where her AGI is only $30,000. Again, we're going to progress from the least restrictive limits to the most restrictive limits. In this case, when we take her $30,000 worth of AGI and we multiply it by the first limit of 60%, we'd find that she has an AGI contribution limit of $18,000. Her actual contributions of $1,770 are still way less than this, so she's still going to get to take the full value of her cash and mileage contributions. When we come to the 50% of AGI limit, we're going to do the same thing where we take the $30,000, we multiply it by 50%, that would give us $15,000, but we're going to subtract off the cash contributions already deducted, that's $1,770. Here, her 50% AGI contribution limit is now going to be $13,230. The value of her excess possession donation of $160 is still well below this contribution limit, so she'll get to take all of that as well. However, when it comes to the contribution of her stock to the church, she made a contribution of $10,600, but 30% of $30,000 is only $9,000. So even though she has plenty of remaining 50% AGI contribution limit left, she's going to be restricted to taking $9,000 of that stock donation. In this case, her current year contributions of $12,530 will be limited to $10,930. She can carry that unused contribution of $1,600 forward to a future tax year. But let's go back to the primary question that we want to know about deductions from AGI. If these charitable contributions were Courtney's only itemized deductions, what's her tax benefit from the $12,530 she donated? Nothing. She would continue to take the standard deduction. And that doesn't matter whether she gets the full deduction or a limited deduction. For a brief period, individuals were allowed to take either $300 or $600 if they were married filing jointly as a from AGI contribution, even when they were taking the standard deduction. However, this was not renewed, which means for your exams that focus on the tax year for 2022, you should not allow a $300 or $600 charitable contribution. Now let's talk about casualty and theft losses on personal use asset. The first thing that you should understand about this deduction is that it is only available if the loss is attributable to a federally declared disaster. When it came to the recent news with respect to the train wreck in East Palestine, Ohio, that incident is not a federally declared disaster, so all of the losses that individuals in the surrounding area may incur are not going to qualify as a casualty and theft loss that is deductible for tax purposes. If the event is a federally declared disaster, then your deduction is going to be limited to the amount that's not reimbursed, and you must also reduce it by a $100 floor per incident and 10% of your AGI. Let's look at an example to help us understand these limits. Assume that Amani's home in Florida was lost during Hurricane Nicole in November 2022. The first question that we need to ask is, was this a federally declared disaster? And if we go to FEMA's website, we can see that Hurricane Nicole, which occurred in November of 2022, is a federally declared disaster. Assume that Amani purchased the home for $180,000 just a few months prior. He received insurance for $168,000. His adjusted gross income is either $65,400 or $165,400. And the question is, what is his allowable casualty and theft loss deduction? Let's start with the case where his AGI was $65,400. His basis in the home was $180,000. His insurance payout was $168,000, so his casualty loss is $12,000. We need to reduce that by both the $100 floor and 10% of his AGI. So his deductible casualty loss will be $5,360. In the case where his AGI is $165,400, Amani has the same non-reimbursed loss of $12,000. However, the requirements that he remove a $100 floor and 10% of his AGI results in the reality that he cannot deduct any of this unreimbursed loss for tax purposes. The last itemized deduction that we're going to talk about relates to gambling, and that's because we've already realized that gambling winnings are includable as part of gross income. You might assume that you can offset your gambling winnings and gambling losses before including them as part of your gross income, but that's not what the tax code allows. Instead, you recognize gambling winnings as part of your taxable income in full. And then if you can take an itemized deduction, you should take your gambling losses, but only to the extent of your gambling winning. To make sure we understand this, I've included an example. Assume that Amani won $500 in a lottery scratch-off. He played the scratch-off each week, investing $10 per week. What is the tax treatment? He's going to include the $500 as part of his gross income, and this will go on Schedule 1, Line 8B. However, his $520 that he spent, which would be his gambling loss, would be limited to his gambling winnings of $500. And so he can take that $500 loss as an other itemized deduction. But if this is Amani's only itemized deduction, then he receives no tax benefit from the loss, but he will pay tax on the winnings. Now that we understand the for and from AGI deductions allowed to individual taxpayers, let's just recap. With respect to the student loan interest deduction, that is a for AGI deduction. If the taxpayer is eligible to take $1,200 in student loan interest and they're in the 12% marginal tax bracket, then they are going to have a net cash outflow of $1,056. Assume that the taxpayer also pays mortgage interest, but that's their only itemized deduction. If they pay $14,150 worth of mortgage interest, then that's only going to reduce the taxes by $144 because the taxpayer would have gotten the $12,950 standard deduction regardless. They only have an excess deduction of $1,200. Again, they're in a 12% marginal tax bracket. So they spent $14,150 on mortgage interest to save $144 in tax, which is a net cash outflow of $14,006. A lot of times people will say things like, oh, it's better to buy a home than it is to rent it because you save so much on taxes. Well, those previous examples probably should lead you to the reality that that's likely not true for a lot of taxpayers. Assume that you have two options. You could rent a home for $12,000 per year. On the other side, mortgage payments, including escrow, are $16,800 a year, with $4,800 in interest and $3,200 in property taxes. The question asks, what's your tax savings from buying the home if you have no other itemized deductions? Well, coming back to the reality that if you're single, you would get a $12,950 standard deduction, and these are your only itemized deductions, you're going to take the standard deduction. So you receive no tax benefit just from making mortgage payments. With that said, you've already learned about the 121 exclusion. So that's not to say over the long run that it might be more tax optimized to purchase a home than to rent a home. But in the current decision-making framework, there is usually not a tax benefit to taxpayers who own a home over those who rent. You should also be aware that there are benefits to renting, specifically with respect to flexibility and not having unexpected expenses arise should there be major repairs required for a particular home. Hopefully, by the end of these videos, you're not only familiar with the various deductions that are allowed to taxpayers for and from AGI, but you also are well prepared to help taxpayers make tax-optimized decision-making when it comes to the various expenses that could be incurred that would be eligible for deductions. When it comes to the deductions from AGI, I just want to remind you what I've said in class, that I'm largely going to focus the exams for this class on the tax rules that apply to the vast majority of taxpayers. In this case, that means you're likely to see a standard deduction. However, you should be aware of itemized deductions for two reasons. One, there is a sunset provision coming up that will reverse this trend, indicating that there are going to be a lot more taxpayers who are going to take itemized deductions if Congress does not take actions to extend the higher standard deduction limits. And secondly, if you're going to take the CPA exam or do taxes, people are very curious about the itemized deductions and the tax benefits that they can receive. And you're likely to see test questions on the CPA for itemized deductions. So I want to make sure that I cover them in this class so that you are ready for everything that comes after this class.